About 5 years ago, I read the book by Benjamin Graham called The Intelligent Investor, and he is the mentor to Warren Buffett, the Oracle of Idaho. And when I read this book, it taught me about the fundamentals of value investing and how you buy a company, not the stock. You don't buy the stock ticker, you don't buy the volatility of that price movement. You're buying the company. And if the fundamentals of that company are continuing to grow, and the innovations of that company are continuing to grow, you have ownership of that company and it gives you a vested interest. A few years after, I made some highly concentrated allocations to assets that I understood, that I was extremely excited by. And that's just led me down a path of being more curious and more interested. The reason I made this channel was because I wanted to archive my curiosity. This channel will never meaningfully provide for me. It won't ever make a difference. It'll never be something that I can monetize. And so when I put this time into these videos, it's from a place of true enjoyment and hopefully being able to frame how I make my decisions and what I am doing based on the way that the market and the fundamentals of the macro and the fundamentals of certain companies and the fundamentals of certain sectors are starting to shape up. So if you get value from my curiosity and borderline obsession with understanding fundamentals of specific companies and the macroeconomics, especially within the USA, then like, comment, subscribe, and continue to follow these videos as I start to frame my decisions around the data points that I like to follow. So let's kick off this video with a guy called Julian Bittel. And he sums up so perfectly just where I feel we are in the market. Even though the seasonality of September isn't always the best, usually in the past, when you have a spring correction like we did in April, where we corrected 20% in the S&P and just over that in the NASDAQ, the summer doldrums don't usually play out the same way. This has happened on 3 occasions historically. And so we are in a very volatile period where September usually brings opportunities to buy. And then we've got the S&P 500 at just over 22x its forward earnings, which is the highest it's ever been historically. And that usually means that we're in this wall of worry. And I feel that a correction could come at any point, and that correction could be bought up very quickly, and that could lead into the rest of this year being very positive. With the Fed cutting rates and that cycle starting to play out now, they've just cut the rates by 25 basis points. They'll continue to do that in October, just based on the trading markets. And then November and December, if this trend continues, this could be the beginning of the business cycle. The Institute for Supply Management hasn't gone over 50, which usually means an expansion in the market. So we've got a lot of really interesting factors that Julian Bittel really likes to follow. And he says most people are overcomplicating the idea that Bitcoin's traditional 4-year cycle can extend. It's simple. If the business cycle extends, the crypto cycle extends. Bitcoin is a macro asset. And I look at a lot of assets that I follow and companies that I follow as macro assets, as interest rate sensitive assets. When the interest rate is lower, people have more access to easy and cheaper money. They deploy that into the products that these companies sell. Tesla, cars, Apple phones, Amazon, all the products that they sell on their internet marketplace, and it just continues to grow. And so you'll find a lot of these companies do very well in the final quarter of the year on their earnings and their deliveries of the products. So there's 23 trillion in Chinese savings yielding nothing as money market yields drop to the lowest on record. How soon until locals discover they can buy crypto through Macau again? Basically, what Zero Hedge is saying is, with 23 trillion in money markets in a deflationary economy in China, and you've got over 7 trillion in the money markets in the US, and with interest rates coming down, it's just going to basically open up the tap of that liquidity. That liquidity is going to start to find risk because it wants to outperform this lowering interest rate cycle that we're now entering into. And so you've got all of this extra cash, this liquidity, it's going to find risk. And therefore, I feel that we've just got so much more time and more room to run. So even if there is concerns and the seasonality isn't great, I'm still vested for that cycle to continue. That's my decision based on this data. Another really important part of this is the dual mandate has changed to a three-legged stool for the Fed. They're now going to start to intervene in the bond market. Buying up the bonds means that they're going to inject more money into the economy, which is just basically through accounting entries in the commercial banks. They're going to be able to add more liquidity, means that there can be more borrowing. And that liquidity just goes through all the system very quickly and the economy expands and assets inflate. And another part of this is when Fed Jerome Powell started to say that his concern is no longer inflation, even though that is continuing to slightly go above that 2% rate that they're aiming for. He's now focused on jobs. And if the job market is weak and the BLS data that they use, the Bureau for Labor Statistics, which is extremely useless in many ways because they revise the jobs down, and they did just recently revise it down 1 million jobs, which actually didn't exist. He's going to use that as his focus for whether he continues to cut rates. And so if they're not focusing on inflation, they're focusing on jobs, then we still have a lot of room to run because the jobs data is not good, which means that the rates will continue to come down. And then this is just the US total liquidity versus the US public debt. And usually when it hits these red danger zone areas, you have a reverse movement in the amount of liquidity that starts to grow. It just means that there's going to be more money supply, an expansion in M2 money supply. Why are these assets going up if they're not actually fundamentally growing? They're not innovating, they're not producing better products, but they're still managing to grow in terms of their stock price. I just don't understand it. So I started to delve deeper into the fact that it is just an inflationary system that we're in. And this is just another layer to the fact that asset prices continue to increase. The consumer price index, the actual CPI, is way higher annualized at 4% than this 2% inflation trend since 2020. So the reported inflation rate of 2% is actually more like 4%. It's a lot higher because of the fact that the value of the dollar does not buy as much as it used to buy. And this plays out again in this 10-year percentage increase. The US money supply has gone up by 83%, but then the home prices have gone up by 90%. So this Case-Shiller National Home Index just basically shows that home prices are increasing at the same rate as the increase in M2 money supply. So the home prices are inflated. They're not actually outperforming that inflation rate, which is what you have to really try and think about when you invest. It's how do I beat the M2 money supply debasement and then this actual CPI inflation rate? So if you take that 4% and add 12%, it's like a 16% hurdle rate just to stay where you are. And to beat that, you're going to need to go off the risk curve into assets such as crypto assets like Solana, Bitcoin, and then also companies like Nvidia, Meta, Tesla, Taiwanese Semiconductor. These are not recommendations. And for me, if you've followed this channel for any length of time, you'll know that I'm vested in Tesla because that's the company that I believe in the most. I also have Bitcoin and Solana as crypto assets, and I have a few other things, but I won't go into details about that in this video. I'll just go through the fact that it frames my view of where you should be allocating capital because you need to try and beat the 16% inflation and debasement combination. And then this is really interesting. The top 10% income earners in the US now account for nearly half of all consumer spending, which is a record high. It goes to show that that top 10% are starting to now bring up the whole economy because they have the spending power. That top 10% are growing wealthier as that bottom 90% start to struggle. And it's just showing that there's this wealth inequality gap that's being massively accelerated by the increase in debt, by the increase in bonds being repurchased, which is just adding empty money supply to the system. And that inflation rate is going to lead to asset prices going up. Real income growth is not going to keep up with the asset prices. So asset prices become much harder to attain when you rely fully on income growth. A few forward-looking indicators that help me understand whether Bitcoin, which really does lead the economy and it leads risk, I feel that Bitcoin still has more room to run, and that's how I'm positioned for this. And I know that gold has a 30-day lead, and gold continues to make new all-time highs. And just based on this year-to-date annual return for gold, it's 40%. Gold's not stopped yet, and it continues to make new all-time highs. Bitcoin lags by about 30 days. And so I feel that Bitcoin has a lot of catching up to do. And then the Pi cycle top indicator really shows this, that there's still, based on historical trends, it's so accurate. Every time the 350-day moving average times 2 converges with the shorter term moving average of 111 days, when they converge and that 111 days starts to touch or come close to the 350 moving day, you start to find that this is where the market tops out, and it mean reverts and it comes down for a long period of time, multi-months. The reason that is because that 350-day times 2 is a long-term price range. It's a long-term price average for Bitcoin. The shorter term 111-day shows volatility and spikes. Sentiment can change and get euphoric. And so when that starts to cross over that longer-term trend, you start to see that that's where people are getting excited. That's where large volumes of cash are starting to rush in to an asset. And that's usually where markets get euphoric and they top out. And as that has not happened yet, I feel with sentiment being so subdued at currently under 40, which is fear in the crypto sector, it just really isn't a top for me in just where we are in the cycle. ISM still under 50. The Fed have just started their cutting cycle. I just feel that there's so much money on the sidelines in the money markets, and there's just more room to grow. However, some caveats to this is even though the equal weighted NASDAQ is still not at all-time highs, it's kind of chopping sideways. This basically means if you give an equal weighting to all of the companies in the NASDAQ, NVIDIA, Meta, even though they make up a much larger proportion of the NASDAQ index, if you give them an equal weighting, they still haven't broken the all-time highs. So that shows that there's still a lot of room to run. We are in extreme overbought conditions. And this is just based on historical 50-day moving average spread. You've got this extreme overbought condition. This reading has only been above 85% on 0.04% of trading days in NASDAQ's history. This just shows that we are trading in extremely uncertain territory, and therefore there could be a correction at any point that you should be prepared for. I'm still massively invested in the market and in a long position just based on where we're going over the course of the rest of this cycle. But we are in overbought territory. We are in extreme conditions where you should be mindful and aware that there could be opportunities to buy at the end of September, start of October. And then the NASDAQ percentage of overbought closing levels between 1953 and 2025 has just gone over that rolling 4-month total, 92.9%. So we're in, based on this data, overbought conditions in the NASDAQ. But that doesn't paint the full picture. There's still more to this story. But there's still more to this story, with NVIDIA investing $100 billion in OpenAI, and this is the largest ever investment in a private company. I feel this is important because when NVIDIA basically create this flywheel, they're giving this $100 billion to OpenAI, who are going to then use that $100 billion to buy data centers from NVIDIA. So it's kind of going back into NVIDIA's earnings anyway and into their revenues. The reason why I feel like even though the NASDAQ's in overbought territory, I feel there's still so much room to grow, because when you look at Costco and Walmart, they're at 47 and 34x their earnings. And NVIDIA is only 26x its earnings. NVIDIA is growing at a rapid pace, and it's in the sector that's going to see the most growth in the next few years. And yet the PE ratio is only 26x. Which shows that this is still a reasonably priced asset. And then splurging on AI continues to grow at now $369 billion. The Prime book, which shows where hedge funds are positioning, and they're positioning positively for technology. And that's, again, starting to go into that deviation of being extremely well-positioned. And when hedge funds do this, they're trying to get ahead of the trend. Joe Badgie brings in this very important question of, is it a bubble? When you have these types of applications that can allow you to build websites so quickly, you're basically allowing AI to start to function like a billion Chinese high IQ individuals, but you're paying them such a small amount. They're invisible workers. And in the past, 95% of AI investment had no return on investment. It had no return on capital. Now he believes, and he's a technologist and a pioneer, and he studies this sector every day. He thinks that 95% is going to equal basically survival condition. You're going to need to have some use and leverage of AI in your company in order to even survive. And that's going to be by the end of 2026, by his estimation. So he is an economist I really trust, and he believes that we're not in a bubble. Even though the Nasdaq is in extreme overbought conditions, it can come down and it can sell off for a few days or a week. It doesn't mean that it's going to be the rest of the year. And the seasonality of October, November, and December could still play out positively and then extend because of the ISM into January and February next year. And then that brings me to the company that I am the most excited about. You can position with whatever company that you feel the most confident in, the one that you understand the most. For me and for my curiosity and for what I'm most excited about, and when I look back at these videos in a year and 2 years from now, what would I have been confident with my investment being placed in? And it was Tesla. If I think about my future self, it's going to be, I'm so glad that I made the investment in Tesla. And it's for these reasons. You think about the way that Elon's portrayed and people in the Tesla community are portrayed. It's this love for Elon, buy Tesla, profits, who cares? Tesla to 1,000. And it's this Pied Piper leading this completely uninformed community of investors off a cliff. If you extend the image and you look at where they're actually going based on what the company are doing, it is into this completely revolutionary set of products, this portfolio of products that are just going to generate high margin revenue and that free cash flow. That's where I am positioned. That's what I believe. And so understand the company and you'll understand that this could be a great opportunity. And you can see that the 20% threshold for EVs globally is starting to become surpassed. We're starting to surpass that amount now with China. And when you start to think about the future being electric, the cars are going to be these metal wrapped AI brains that are going to be traveling autonomously. And you're going to need an electric vehicle in order to do that. And therefore, internal combustion engine cars are just going to start to die. And new car sales are predominantly growing in the EV sector. And you can see by these dark blue bubbles in the States where it's starting to grow. And it's just continuing this trend. This data from Cern Basher, just to look at some of the products that are a part of this innovation in the future. You've got Optimus, and by 2030, 1 million robots could be made, and that would increase the actual market cap by $6 trillion. So this is just another product that makes me bullish on Tesla. The next part of the portfolio is by 2028, you could have 1 million autonomous robo-taxis functioning across the states of the US. And that would increase the value of the company to just under 3 trillion. Again, that would have immense impact on the share price. Cern Basher is just someone you should follow. He's got incredible data. He's extremely conservative in the way he estimates all of these projections for these companies. But based on this product portfolio of auto, semis, energy storage, services, robo-taxi, Optimus, Autobidder, and zero robo-trucking, zero Bitcoin, even though they have Bitcoin and robo-trucking is going to become a business opportunity in the future. You can just take these share prices, these future share prices based on the evaluations, and you've got by 2027, the stock going into the 700s. He sandbags these numbers, so he would probably be more optimistic about the share price being a lot higher because you've got to bring forward the fact that the market anticipates the future and usually by about 6 to 12 months. So anything that's going to happen in 6 to 12 months, the market prices that in with the efficient market hypothesis a lot sooner. And so even though these share prices are extremely far away, they'll probably be hit earlier. That's why Tesla's trading at over 400 because people are starting to factor in the story. Doesn't mean it can't come under 400 and go into the 300s, which would be a very good buying opportunity, in my personal opinion. But it just means that the market is so efficient that it brings forward those prices and it factors it in today. This is really interesting data, and it shows that Tesla can never sustain a rally past 7 days. It usually has a 7-day rally, and then it sells off and has a 1 to 2 day correction. Not too high, but when the rally exceeds 20%, it usually, on high volume, peaks out at that point, and then it comes down for 2 days. So it's important to just kind of frame your understanding. If Tesla's on a rally, it goes on a rally for about 7 days on average, and then it also has a correction of 2 days. But that correction of 2 days doesn't bring it back down to where the rally started. So it's important that when this asset starts to move, it can be extremely hard to get into the asset in time. You just got to be able to understand it now. and just understand that it can rally and it can correct, but it can rally much higher than that correction. Tesla, based on Elon's buy of 1 billion, has a multiplier of 84.7 billion. So the increase in the market cap is by 84.7 billion when 1 billion goes in, which is what Elon did recently when he bought 1 billion on the Friday just before the market closed. It hit the market cap by 84.7 billion in terms of its increase. Cup and handle, and it's this long-term cup and handle, and when this plays out, it can take the price into the 500s by the end of the year. This is another cup and handle drawn on the weekly, and it can take the price up to 600 just based on the anchor point of the cup to the neckline of the handle, and then you extend that same distance and it takes you to 600. Again, very reasonable targets for Tesla by the end of the year, just based on everything that they're building and everything that's going to be hyped into 2026 with Optimus, with Robotaxi expansion, with energy storage deployments, with the pull forward of EV sales and that growth in the compact vehicle, the Model Y, L. There's so much to be excited about with this company. And the reason why I'm going to use Bitcoin as a way of trying to explain how it could all be relevant is just understanding that this asset is extremely scarce. A liquid supply at 28%. You've got the liquid supply at 67%, but you can see that that still to be mined is starting to come down. And also the liquid supply is starting to come down from 73% to 67%. And then we've got this extremely important chart pattern that's been found by Colin Talks Crypto, and it's a perfect bullish megaphone, the big bullish megaphone. And then you've got inside this, you've got the inverse head and shoulders in dark blue, and that broke above. It created a head and shoulders, which is a local top pattern. And you can see in that green, the green shows this bigger inverse head and shoulders, which means that if this bigger inverse head and shoulders still has room to break out up to the 140 to 150K range, that's a forward indicator for all risk assets, which I just look at Bitcoin as a macro asset. If it's going to still have room to run, that means that the rest of the sectors that are risk have room to run as well. Another discovery from Colin Talks Crypto is this inverse parabola regression line for the Tether market cap. And when you hit the Tether market cap, which basically it's showing that this Tether market cap is going up, but actually it means the amount of Tether is going down because it's going into the crypto assets. And when that hits that blue line predicted by the end of the year, that's usually where the market tops, and then the Tether market cap starts to increase. So in this chart, when the Tether market cap is going up, when that line is going up to the parabola, it's actually the Tether market cap coming down because it's an inverted graph. So the main thing you should take away from this is when the Tether market cap gets to about 3%, it goes down to 3%. All of that Tether, the stable coins, are going into assets. That's usually where the assets reach a top and then turn over. And finishing off with the seasonality, currently September is good. October, November are usually historically the best months of the year for Bitcoin. And when you have Bitcoin performing well, risk assets perform well. So if you got value from this video, like, comment, subscribe. I just wanted to give a long-winded, in-depth explanation for how I frame my decisions. It's about me being able to look back on these videos and go, okay, that was the right decision. I can learn from my mistakes. I can look at the video and say, okay, I was very unaware of certain signals that were flashing that could have meant that the cycle was over. Sentiment was at a certain point where the cycle was over. Or I can look back and go, that was a good decision and it helped and it's led to more improved confidence in decisions that I make going forward. So I'll see you in the next one. Thank you very much.